first thing to consider is really simple. Location, location, location. We've all heard that, and when it comes to real estate, it's absolutely true, especially with single tenant, triple net investments. The first part of the location aspect is you want to understand where this property is located. Urban infill neighborhoods will typically trade at a lower cap rate because they're considered a safer investment versus a tertiary market where there's perhaps a lot of open land that's out there. One thing you want to consider, especially in tertiary markets, is where specifically is the property located. And what I mean by that is, what are the other traffic generators in the neighborhood? Are there schools? Are there large businesses? Is there perhaps a regional mall that it's an out parcel to? Also, within the street itself, where is it located? The strong preference for most investors and most actual retailers is to have a hard corner location. By hard corner, I mean a corner location that's signalized. Second optimum location would be, of course, a corner location, and then there's one that's in line. So take into consideration where the property is located specifically, but also the general area when you're looking at the investment, and then adjust your pricing and your expected cash flow from that. So I often get asked by first-time investors, why would I pay $800 or $1,000 per square foot for a building that in the area other buildings are selling for $200 or $300 a square foot? Well, it's not just the building that you're purchasing with the single tenant triple net lease investment, you're also purchasing the lease. And so that really plays a factor into the value of that property and that investment, especially the length of that lease and the lease structure. So what you want to do is take into consideration, how is this lease structured? Does it have increases every year or every 5 years? And do those increases potentially keep up with the cost of living index so that you're actually keeping up with inflation, and at the end of 15, 20 years during that lease term, that you'll actually have an investment that's at market rate. One thing you also want to consider, though, is that are the increases too high, and if the tenant can't afford them? Because the last thing you need, since you are buying this as part of the lease and the length of the lease and the cash flow from that lease, you want to make sure that your tenant is going to be able to afford those increases down the road. So take a look at it, make sure that it's fair, equitable, and that it works for everybody else. A good way to analyze the actual lease and the lease value and what the value of the lease brings is to do a discounted cash flow analysis. So what you can do is understand how many payments that you're going to get over a period of 15, 19, 20 years for the original term of the lease, and then using a discounted analysis, figure out the net present value of what that lease is worth today. And then you can actually see what kind of value it adds to the property and why it's wise to pay $700, $800, or even $1,000 per square foot for a building. So the cash flow and length of the lease is only as good as the strength of the tenant. So that's also something that you need to take into consideration. This is why companies such as McDonald's or Starbucks that are all corporate guaranteed leases trade at a historically lower cap rate than their competitors. And that can be as much as 2% lower cap rate or 200 basis points. So take a look at who the tenant is. If it's a franchisee, I would look for franchisees that have 30 units or more. And then if it has less than that, then adjust the cap rate so that your risk and your return is adjusted for that. So take a look at who the tenant is, what their history is, how long they've been in business, and also, more importantly, what kind of strength do they have? Is it just the guarantee of the company, or is it also a personal guarantee? One of the tricks to be aware of with franchisees is that many times a franchisee may have 100, 200 locations, and they appear to be very strong. However, the entity that actually guarantees the lease has been broken up and only holds 3 or 4 of the locations in place. So be aware, take a look at who the actual guarantor is, and then, like I said, adjust your returns for the risk that you're willing to take on. So in addition to the strength of the tenant, we also want to take into consideration the strength of the brand. History has shown us that there are many brands out there that have been able to rebrand and adjust and adapt to the changing times. McDonald's has done a very good job with that. Carl's Jr. has adapted quite well. CVS, Walgreens, there's quite a few out there that have been able to adapt and adjust to the changing times and appeal to what the consumers are looking for. Take a look at those brands versus some of the older brands that are maybe a little bit too tired or too staid, and with the changing taste in the consumers may grow and their sales fall down. So a good way to track that is actually to see what system-wide sales are overall when it comes to the brand itself, but also take a look at what they call the average unit sales. And what I mean by that is, typically a location will have, or a brand will break down the average store sales per unit. And what we'd like to do is see that, especially in a growing economy, that every year they are growing at least as much as the CPI or Consumer Price Index, preferably more. So overall, there's a lot to take into consideration when it comes to a single tenant net lease investment. Not just the actual cash flow, but also you want to take a look at the location, the length of the lease, the strength of the tenant, and the strength of the brand. Those are just some of the factors that really can affect the actual value of the property and the return that you should be receiving. So by doing an analysis, taking a look, and delving deep into each one of those aspects, you can adjust accordingly and use the risk versus return thought process and adjust your return to reflect the risks that you're going to be taking on. So thank you for your time, and if you'd like additional information, please feel free to visit our website or even contact me at 310-943-8536. I'll be happy to help you out with any of your questions for investments on either single tenant triple net lease investments or any other type of investment.